All right, thanks, Christina, and thanks everybody for joining us tonight. I know there's lots of other things going on TV and throughout the world, so we are going to go over the LPL Financial Outlook for 2021, and they've titled this "Powering Forward." So just to give you guys a glimpse of what we're thinking for 2021, and I'll just stop my camera here while I go through the presentation so it's not distracting. All right. So 2020, as everyone knows, was an unusual year, and we had many challenges. And now that it's 2021, we think that it's time to restart the engines. And you can see the theme from this main slide that we're kind of looking at the engine bay of a vehicle here. We think things are going to look different and feel different this year. 2020 changed many things, the way that we do business and the way that we connect with you. Mainly, we did these Lakeside chats starting in 2020. In Outlook 2021, Powering Forward, that we're going through, we're going to talk about stocks and bonds, the economy, and the post-election policy environment. So a little bit of policy in Washington. In the background, though, there's going to be some new challenges as well, and some new opportunities to go along with them, and new ways of doing things. So in terms of policy, we're going to be charting a new course. And as this chart shows us, stock returns historically have been strongest when Congress is split. So meaning that there's not a strong majority with either one. And that's really what we expect in 2021. I know some of the news today said that there may be a small majority for one party over the other, but really when we're looking at a Republican Congress versus a Democratic Congress, we're looking at a larger majority. So I'd say we still pretty much fit into that split Congress category. As you may recall, for the economy, it was improving nicely early in 2020 after we had somewhat of a modest slowdown in the fourth quarter of 2019. And then it skidded to an abrupt stop in the face of COVID-19. The pandemic ended the longest economic expansion ever, one that we had going for more than 10 years. This recession was caused mainly by the government closing businesses. So you could say it was somewhat self-imposed between people choosing to stay home in response to COVID-19 and the government closing down parts of the economy. And once the economy began to shift into gear again later in 2020, it's likely that a new economic expansion started. Right now, the expansion might be only a few months old. However, with record amounts of monetary and fiscal stimulus, both of those things working, that is firmly in place, and we have a viable vaccine. Actually, we have a few of them, likely to work its way around to most US citizens early in 2021. We anticipate that there's going to be many years of growth ahead. With this chart, it shows the average length of an economic expansion has been, you see there the average line there, 5.3 years. So it looks like we have a few years to run if the past is any indicator for the future. So far, the economic recovery, we've had two different types of recovery going on there. There's a services part of the economy, and that was hampered with restrictions, while manufacturing and goods production moved forward at record speeds. So this has led to what some are calling a K-shaped recovery. A K has one part pointing higher or improving, and the other part is pointing lower or it's deteriorating. Either way you want to think about it. As is common during recessions and recoveries, parts of the economy have been improving quickly while others are lagging. So that's kind of where you get that K shape. Parts of the economy are going up, parts are going down. COVID-19 impacted service industries. Those are going to be the ones that are probably the last to bounce back. If you look at this in relation to workers, then this recession and the recovery have widened the divide between the haves and have-nots. So you see a lot of people doing very well and some really, really struggling. Continued progress in the response to the pandemic included further stimulus, and that will be a key to sustaining the recovery going forward. We expect some of the innovation and kind of rapid fire innovation by lots of different companies as a response to the pandemic. That's going to have long-term impacts that are really positive. So as the pandemic subsides, hopefully somewhat soon, and restrictions are lifted, consumers' daily lives hopefully will return to something more resembling normal, and the pace of our recovery should pick up speed. We expect this to happen about mid-2021, fueling what we think is above average GDP growth for our country for the whole year. We're forecasting between 4 and 4.5% US GDP for 2021. Emerging market economies, think of some countries in Asia and South America there, they may be leaders in the global rebound. We believe that growth also in international developed economies, which you think of the greater Europe area, they are probably going to lag behind the US. Although a strong fiscal response is probably going to help Japan, which somewhat gets lumped in with the international developed countries. We forecast global GDP growth between 4.5% and 5% as well. Inflationary pressure is likely to be limited for the time being for 2021. And the Federal Reserve, also known as the Fed, is expected to keep interest rates low. For stocks, we're looking at an earnings rebound. So many of us might say that 2020 was one of the most difficult years we've experienced. The worst pandemic in 100 years, a deep recession, a bear market, election uncertainty. Yet 2020 has been a good year for stocks. So remember, the market is forward looking. As bad as 2020 was, stocks are likely to be looking ahead to better times for this year. A strong earnings rebound in 2021 might allow stocks to grow into somewhat elevated valuations, meaning that they're going to get more expensive. Cost efficiencies achieved during the pandemic may persist. So companies that figured out a new way of doing things, and they've gotten very good at that, they may be poised to take advantage going forward. We see an S&P 500 index, the major index you see a lot of the times across your TV screens, a fair value target range for that between 3,850 and 3,900 for this year, with potential upside for better than expected vaccine progress. And as the threat of COVID-19 somewhat diminishes and the economy moves closer towards reopening, we anticipate corporate America is probably going to have more improved earnings potential. We estimate earnings per share is kind of a difficult thing to discuss, but mostly we anticipate most companies earning more money, and that makes their stock price look better. So we estimate about $165 in earnings per share for this year. We see also the 10-year Treasury yield finishing 2021 in a range of 1.25 to 1.75%. And our bias is that it's probably going to lean towards the lower end of that. So, we're probably looking at yields staying pretty low, interest rates low. I know these are some funky numbers and a lot of you don't really look at these too often. Any questions on this stuff? All right, keep going then. Historically, the worst economic conditions have been followed by some of the biggest rallies. So in 2020, the S&P 500 was able to fully recover what we lost in the bear market decline in only 6 months. Usually that takes years. In fact, for the first time ever, stocks are in a position to produce a gain in the calendar year after being down by more than 30% at any point during that same year. That is quite a comeback. So after such
I have a question.
Sure.
I'm sorry. Okay, so what is that attributed to, Adam?
The large rebound?
Yes.
Well, there was quite a few things that actually, it's not certain yet, but there are a lot of different factors that figured into that. Part of it is they think that the market was probably, there was a knee-jerk reaction by a lot of people that immediately, as soon as things started getting really serious with the pandemic, there was a lot of widespread selling. There was also some issues in the bond market that we'll probably talk about a little bit after. But those two things, when stocks and bonds move down together, that's generally a bad thing. So really, when everyone was very panicked at the beginning, and then we started getting better news, the market really reacted positively to that. So we saw a lot of people saying, okay, we were at very bad and now we're getting to better. So as soon as there was better news and as soon as things keep getting better and better, the market really is forward looking. So it was just kind of saying, okay, this is where we were. If we're looking towards better conditions, they were thinking that further on towards the end of 2020 or 2021, we were doing much better. So really there was an end in sight for most people that watched the market. And that was the big thing, I think, is that they looked ahead and saw that they think things were going to turn around this year that we just entered. So mostly it was optimism, I think, but there was a lot of factors that contributed to that. Does that make sense?
I guess, yeah. I guess just with so much unemployment and people losing jobs and
doesn't seem in.
I'm sorry?
Dolores, did you say something?
Pardon?
Did you say something?
No, I'm talking on my cell phone.
Oh, okay, gotcha.
Oh,
Okay. Mary, I think that a lot of people feel the same way you do, and that the high unemployment is a factor, and we tend to agree with you that it will be a factor for probably the first 3 to 6 months of the year. But one of the charts that Adam showed was that, the have-nots and the haves kind of are splitting even more than normal. And
yes.
so, yeah.
Yes.
The unfortunate part of that, or fortunate, depending on which way you look at it, is that those that still have are spending quite. I don't know if you saw the news the other day. Locally, they were saying, Toyota
Yes.
the amount of Toyotas sold in December was up an astronomical amount.
Mm-hmm.
Yes. Yes.
It's automobiles. Because of COVID, people are buying cars in cities where they used to drive. Because of COVID, housing sales are going through the roof.
Yes, I know.
It's
amazing.
Live in single family houses.
Updates to houses, their own houses. People are spending money.
So that drives the economy. And to your point, there are people, 30% of the businesses will be displaced due to food services and things like that. But technology has experienced 10 years of growth in 1 year.
Okay.
And with any type of impact like we've had from COVID, there's always going to be new businesses that are not even thought of today that are coming out in the next 6 months, right? So
true.
Yeah. So while it seems hard to imagine past this immediate time where we know there are so many people out of work and people struggling, even if they're underemployed, after and we hope to get through everybody getting back to some kind of full employment, then things are looking more positive than they have in a little while.
Okay, people are spending money. I know.
People are
You
spending
go into Lowe's, you go into, yeah, and just Amazon over the
Amazon.
holidays.
Yeah.
It took forever to get, yes, your packages. Yes.
Okay, today's the 6 a.m. or 5:30 a.m. news this morning was that Amazon bought what, 11 more 757s for transferring their goods because I mean,
Wow.
people are shopping like crazy.
Yeah.
Yeah, online. Yeah, they are.
Well, and think of what we're using right now. You know, we're video conferencing, and that's pretty mainstream right now. Whereas that
Yeah.
too popular. I mean, in some circles it was before 2020. But there's in the K-shaped recovery that we're looking at people doing better, people doing worse. We're also looking at different companies doing better, different companies doing much worse. You know, there's the travel industry. Then there's technology companies, which had a banner year. So I think all over there's lots of separation, no matter how you look at it.
Adam, it would have been interesting if this graph showed longer into the future to see if the lines converged again, or if they expect this difference to stay.
Sure.
Time.
Yeah, and I mean every situation is unique, but usually the idea is that they will converge somewhat again. But I think there is an issue in our country in general with you have gaps all over the place between wage earners. So I think especially when you run into a time like there is now where you see a lot more remote workers and things based off technology, you may have people unemployed because their job may no longer exist, or it exists somewhere else instead of where they used to have their job. So I think there's going to be lots of challenges, but you know, there may also be opportunities.
Okay, it makes sense.
In a roundabout way, doesn't it?
In a roundabout way, exactly. And I'm, you know, and my background is social work too. So, you know,
Right.
It's just the other perspective is what I see a lot of. But
Absolutely.
you know, yeah, I get it.
It's a great question though, because even I was wondering, with the GDP expected to be above average, not even just average. Average, you know, you would think that there's going to be some kind of pent up demand from there, or within that, but it's mind boggling.
Yeah.
Well, it is, because I'm redoing my kitchen right now, and long story short, it's hard to get supplies because there's such a tremendous demand.
And they're expensive, yeah.
Oh, wood is like quadrupled the cost of lumber.
Yeah.
Yes.
No, there's a lot of positives happening on the economy, and we're going through a transformation of how we do business, how we shop, how we communicate. Historical change.
You know, I wonder if they look back at this in 10 years, they actually call this a revolution, right? Because we had the Industrial Revolution. Is this some kind of
moment, without a doubt?
Yeah, I completely.
Well, there's a revolution in Washington today.
Yeah, well,
yeah. Pandemic ending in a revolution, more than one.
Yeah,
that one we don't like.
I'm sorry, I didn't mean to divert, but whoa.
All right, on that note, Adam.
Yeah.
All right, so if we kind of get back to when we're talking about that rebound idea, when we thought that it would it usually takes years to come back from these things. It was a quick rebound, like you pointed out, Mary, and there was a lot of reasons why. I'm sure they're going to be unpacking all of those factors for years to come. But what's interesting is that normally after a large first year rally, after a big decline, there's actually a sustained rally. So this market goes up more, or it continues to go up even after that first year. So that's what you see there with the blue and the orange bars. It'd be logical to think that returns are going to be more muted in the future, but this shows us right here that stocks do tend to add gains well after that initial surge.
Is there some kind of caveat in there with, of course, there will be normal market pullbacks?
Oh, I'm sure. And this only looks at year by year. So, when you think about a normal market year, even if it's a really great year, when you have an up 30% market, you can still have points during that year that you're down a few times, 10% here and there, 5%. Those things are normal every year. And looking at earnings, corporate earnings fell sharply in 2020, due to lockdowns and recession. People weren't out for a good portion of the year spending money. But despite lingering effects of COVID, this year we expect the economic recovery to drive a big rebound in profits. We potentially could see the S&P 500 earnings growth of 25% in 2021. And that's boosted mostly by cost efficiencies. So, like we said, companies getting better at what they do. They learn to mold themselves to adapt during 2020, and that will pay off going forward. Looking at bonds, the economy may be kicking back into gear, providing a possible tailwind for stocks. But that isn't the same story for bonds, especially investment grade bonds. An improving economy generally leads to higher interest rates, and when interest rates go up, bond prices go down. So they have an inverse relationship, and that will weigh on bonds' total returns. There's still going to be opportunities for bond investors this year, but it may be a year that requires more patience. We're probably going to have to lower our expectations a little bit and have a more opportunistic approach. So we're going to be very picky and choosy about the things that we look at in the bond universe. Inflationary pressure is likely to be limited for this year, and the Fed is expected to keep rates low. But economic improvement and normalizing inflation could put upward pressure on those rates. So they could go up possibly faster than we think. So that's something to keep our eye on. Overall, based on our view of rates in the economy, we expect near flat to low single-digit returns for the U.S. Aggregate Bond Index. It's got a big long name, but we just call it the U.S. Ag this year. And there is some potential for losses. So that's why we have to be very picky. The 10-year Treasury yield, it provides a baseline for our fixed income views based on what this Treasury yield curve does. And we are targeting a yield range of between 1.25 and 1.75 that we said earlier. For most people, this doesn't mean much. It basically means really that the rates aren't going to move a whole lot. From a historical perspective, the large decline that we had in yields from the first quarter of 2019 to the first quarter of 2020, it does point to an increase in yields at some point. Since 1990, we've experienced 6 of these declines that were at least 1.5% over a year. You can see that on the chart. And in all 6 cases, the 10-year Treasury yield was higher a year later by an average of 90 basis points. That means 0.9%, so just under 1%. As well as 6 quarters later, so think year and a half, it was up 1.1%. So it doesn't move very much, but it does move.
Well, and the other thing.
Oh, go ahead.
Oh, did somebody else talk? No. The other thing I want to point out, Adam, is that this is dated 11/1/20, and as of today or last night, the Treasury shot up above 1%.
Yes. Mm-hmm.
So we're probably looking at a different. We're definitely looking at a different trajectory now than it was even 3 months ago.
Yeah, and really the point of this chart is to show how much it moves around. So I mean,
within a quarter.
there are times when it can shoot up rapidly, and sometimes we'll see large spikes and deep valleys. But really, if we expect things to be somewhat going in a normalization pattern, then we can expect some gradual increases, even though there may be some sharp points in between.
Yeah. And I think that their range is still accurate though for the entire year.
Yep. Mm-hmm.
What it tells us is our rates are going to be low for quite some time.
Yeah.
So you're not going to get much interest on bank accounts, and when 10-year treasuries are barely 1%, that's a long term to be making that low a return.
Mm-hmm.
Yeah. I mean, I think I saw a Vanguard money market that was doing like 0.02% or 0.01%. You're not getting anything.
Yep.
So is this based on what mortgage rates are as well? Because they're very low right now too.
They are low.
Mortgage
The
rates.
10-year treasury yield is kind of the baseline for a lot of different other interest-bearing instruments. So if you think about auto loans, mortgages, when you see changes in interest rates and they talk about the treasury yield, those other things are going to move with it, but they're usually higher than this figure is.
And it's usually based off of the Fed fund rate,
Mm-hmm.
Mary. And so
Mm-hmm.
it's definitely a different rate, like Adam is saying, but everything kind of ties together. They're just different indexes type of thing.
Yep.
They're all unusually low.
Yes.
Yes, right now, yeah,
Yep.
they are. I agree.
So you're not getting
Not that I'm gonna-
getting anything in the bank, but at the same time, you can go out and get a 30-year loan right now for cheaper than ever.
You can buy a
Absolutely.
bigger house and afford more because the interest rates are low,
Yes. Yeah.
which is what's fueling housing.
Yeah.
Part of
Yeah.
Despite those lower return expectations, if you look at high quality bond holdings, that you're looking at companies that are able to pay their debt, those kind of investment grade companies, they may continue to play their role as portfolio diversifiers. The reason we keep them around. During the 6 stretches where the S&P fell at least 10% between 2010 and 2020, treasuries typically led and the US aggregate bond index gained on average. So if you look at that group all the way over the right where it says return percentage, you can see the different dates going down through how the Barclays aggregate compares with the S&P. So stocks and bonds and treasuries all that's a completely different picture when stocks are down. We think that the diversification benefit for some bonds still exists. And there's an important lesson in this. So even when you're positioning for a rising rate environment, so when we think rates are going to go back up, we know bond prices are going to fall, but exposure to some bonds, core bonds and treasuries, they can still help provide that important ballast that we need. So if rates do run higher because of a strong economy and the economy growing, potential stock gains can probably offset some of those bond losses if they occur, even though we need that diversification. And this is pretty much the last of our slides here. It's just kind of a graphic. It tells us the journey continues as it always does. We're not sure what's coming around the curve, but we're going to look at everything going on in the economy and in the market and make sure that we have a heads up view to do what's best for our clients and make sure that we're giving you all the information that we have that you find useful. And then of course we have a few disclosure slides as always. So thank you for joining us for this presentation. We appreciate it. If you want to look at these disclosures more in depth, you can. We can always give them copies to you. And that was all that I had for the presentation today. So I'll just quit my share here, bring us all back. So does anyone have any questions on that? I know there was some thick material in there at times. Did this raise questions for anyone or anything you want a little more clarity on?
Well, and first I want to say, Adam, we do have the link to that up on our website. So if anybody wants access to the Outlook to check it out on their own, they're absolutely able to do that. But if anybody needs Adam to pull up a page again today, he can do that. And a quick welcome to Jean. I saw you just joined us a few minutes ago, so I wanted to say hi. So any questions for Adam? You did a great job, by the way.
Oh, thanks.
I know it's a tough, some of those those topics are sometimes a tough one to get through, and it was good. You made it very understandable.
Oh, thanks.
Yes, I agree.
I
Thank
get
you.
a little lost in the weeds, but I'm kind of a nerd about this stuff. So if I did get a little deep there, I apologize to anyone.
Not too technical.
No, it's understandable. It was
Good.
You were good. Thank you.
Yeah.
So Jean, I know that you didn't get to see the whole thing. Was there anything that you wanted to know about today, about the Outlook, or that you were questioning?
You're muted, Jean, by the way. There you go.
Yeah. No, there was nothing special. I just got tied up with TV watching at the time.
Yeah, we were all kind of watching the fire trucks. Yeah, let's leave.
Yeah.
Yeah.
Crazy. Happy New Year.
Yeah.
Happy New Year.
Yes. Happy New Year.
Howard, any questions from you?
No.
No, Dolores, you're good?
No.
No?
I'm fine.
Okay, good. All right. Well, if nobody has questions, going once, going twice. All right. And if that's it, then I wish everybody one last Happy New Year and see you all very soon.
Yeah.
Thank you.
Thank you.
Thanks, everybody.
Bye.